Let's talk Bitcoin. Let's talk Bitcoin after what happened with gold. And we're not talking about gold. We're not really talking about Bitcoin here. We are talking about power. And let me explain. Because when you divide Bitcoin by gold, you are no longer measuring price. You are measuring which monetary system is winning. And the chart you are looking at right now asks one simple, dangerous question. Did the BTC Bitcoin to gold ratio just find long-term support? These are the type of questions that we ask on this channel. And by supporting it, you support my effort and you support me helping you better understand what is going on in this market. I want you to understand what is going on in the market. I want you to be educated. What do I want? I want you to realize that it's not about making money in the stock market. It's about not losing any. And the second important fact that you need to realize is that whenever they tell you what is happening, for example, the situation with gold, and then they're tying it up to the fact that we have a new Fed chair, you say, well, looks like gold was impacted by the Fed chair because he might be tougher and stronger with the dollar, therefore enhancing the dollar. But that's purely correlation, okay? So let's just remember that. Correlation is not causation. And just because they say so, it doesn't mean it's so. So let us continue and talk a little bit more about this chart, which I find quite interesting, I must say. So essentially what we're doing, as usual, we're looking at a ratio. We're dividing the Bitcoin to gold. And I guess we're asking the question, did the BTC to gold ratio just find a long-term support? If the answer is yes, then the next phase of markets will not look like the last one. And if the answer is no, then crypto is facing a much deeper reckoning than most investors are prepared for. So there are two panels. Let's understand what we're looking at. The top panel, the blue line, is the Bitcoin price. And the gold line is the gold price. This is not the main event. Okay? The real story is the bottom panel. The red line is the Bitcoin price in ounces of gold, which removes the dollar entirely. So when this ratio rises, as you could see in the square red boxes, Bitcoin is outperforming gold as a monetary asset. When it falls, gold is reclaiming dominance. This is pure monetary competition chart. Not a CPI, there's no net earning, just store of value versus store of value. So now focus on the two red boxes highlighted on the chart. The first red box covers 2020 to 2021. That was the era of global money printing, fiscal dominance, zero rates, peak liquidity. Bitcoin absolutely obliterated gold. It destroyed it. The BTC to gold ratio exploded higher as investors chased asymmetric upside and fled monetary discipline. Remember Bitcoin. Then came the collapse. From late 2021 to 2022, the ratio unwound violently. Why? Because liquidity was withdrawn. This is a concept that we're going to have to go over a couple of times with the idea that Bitcoin is driven by liquidity. We'll do a video on that too. So at that time, rates rose and suddenly volatility was no longer free. Now look at the second red box. box, the one that's more of interest to us, 2024 to 2025, the pattern is disturbingly familiar. Bitcoin surges again, narratives return, ETF flows explode, and momentum traders pile in. And once again, the ratio rolls over. Same behavior, same psychology, different macro backdrop. Now, we get to the most important feature of the chart. The green dashed trend line. This is a multi-year rising support line in the BTC-to-Gold ratio, stretching back nearly a decade. Every time the ratio collapses into this zone, seller pressure exhausts, volatility compresses, and a decision point emerges. We are now sitting directly on that trend line. This is a structure. We're not noises, right? So markets do not respect lines because traders draw them. They respect them because capital reacts there. And historically, when this level breaks and holds, it defines entire market regimes. So, 3 scenarios from here. Scenario 1, the ratio holds. If BTC-to-Gold holds its support, Bitcoin resumes leadership. Now, obviously, since it's Bitcoin over gold, right? As gold dropped, inflation. So Bitcoin resumes leadership. That the risk assets regain dominance and liquidity conditions quietly improve. This would imply that inflation is politically tolerated. Real rates stop rising and monetary discipline remains absent. This is what you call a speculative regime continuation outcome. The scenario 2, the ratio breaks. If this support fails, gold massively outperforms Bitcoin, which has been the case in the past, and volatility premiums collapse. Capital rotates towards stability. This would signal that real rates matter again. Liquidity is constrained and monetary trust is questioned. That would be what you call a defensive regime shift. And of course, the third one is the grind, most dangerous scenario, where the ratio chops sideways. Both assets rise, but gold rises faster. Bitcoin loses narrative power without crashing. This is how bubbles die quietly. So, this ratio is not about crypto. It's about the trust in the central banks, the acceptance of inflation, the tolerance of volatility, and the cost of capital. I know it's a lot to think about. Because Bitcoin thrives when liquidity is abundant, as we have seen. What's happening with Bitcoin right now, the liquidity is not so abundant for Bitcoin. Policy credibility is weak and risk is underpriced. And gold thrives when, trust erodes, volatility rises, and capital preservation dominates. So what's interesting, you don't need to understand everything I'm saying, but basically, the BTC-to-Gold ratio tells which psychological state the market is in. Right now, it's a fragile equilibrium. So what do serious investors, investors do here? Don't forget to subscribe and to give us a like. We do not chase, we do not narrate, narratives. We do not, but we do not ignore the ratios. Watch the trend line, watch the slope, watch the reaction. If the BTC-to-Gold bounces back convincingly, risk appetite survives. But if it breaks, gold is not done. The crypto beta will disappoint and volatility will be repriced. So this chart will lead headlines, but not follow them. This is, again, another regime call. You could see that in that chart. It's important for you to understand that, because what it does, it shows you a shift a psychological shift. So let's go over that point one more time so that you understand what this psychological state the market is in. It basically, we're looking at the BTC, which is Bitcoin over gold, and what we're seeing is that the trust in the central banks, the acceptance of inflation, the tolerance of volatility is one side. And on the other side, you've got liquidity is abundant, policy credibility is weak, and risk is underpriced. And you kind of have, at the end of the day, the liquidity is not so abundant for the Bitcoin. While is policy credibility weak? We shall see. Is risk underpriced? And this is always the thing that bothers me is that people that join as members also, and I tell that to my members, I come to my members every day between 8 and 9 o'clock and say, okay, this is what's happening today. And a lot of them join because they say, well, what shall I do? Where's the market going to do next? What's going to happen? That's the wrong approach. What you need to do is you need to understand. You may not understand everything, and that's okay. Tell that to my investors and to my students. I tell them the same thing. But you're not supposed to understand everything. But you're supposed to grasp what's going on, the psychology of the market, meaning that you're not supposed to know what's causing it. No one knows. I always listen to the social media, but some of the channels on cable and Bloomberg and all these guys. And they invite all these people over, and because they know the people want to know, what do you think is going to happen? But if these people knew what was going to happen, they would do it for themselves, and they wouldn't be here trying to make a buck, trying to tell you what's going to happen, right? So the idea is, it's quite simple, actually. You're not here to make money. You're here not to lose any. That's the most important thing. And the second thing is, don't assume because on one hand they show you, oh, look, gold went down. And look what happened to the new guy that came in. Well, he hasn't come in yet, but the new Fed chair. He's going to be tough. He's going to be strong for the dollar. So therefore, really? It's that simple. Well, he came in and gold went down. It went down. So, maybe that's it. It's like saying that. It's basically saying like that the cholesterol causes heart attack. That's basically the same thing. Look into it, by the way.